Hey everyone, Justin Conroy, Financial Dad here, and today I want to talk about credit scores, what a credit score is, and why a credit score is important, because there's a lot of conflicting information out there about what credit scores are, how they work, what they're good for, and some people even believe that they're a bad thing altogether. But the reality is that if you don't have a credit score, or if you have a bad one, not only will certain milestones in your life be far more difficult, or potentially impossible, they'll also cost you extra money. So in this video, I'm going to talk about what a credit score is, why a good credit score is an important part of making your life easier, and how it can save you money, and finally, I'll talk about the factors that make up a credit score, and what you can do to make sure you have a good one. With that, do me a big favor and smash that like button for the YouTube algorithm, and let's get this started. Let's kick this off by answering the first question. What is a credit score? Well, let's say that you're in need of a loan. You've come to a point in your life where you want to buy a car or a home, and you don't have the cash to outright pay for it. That means you need to borrow some money, so you seek out a lender. How do they know that you'll pay them back? How do they know that you won't take their money and run? Well, this is where your credit score comes in. Your credit score is a 3-digit number that basically tells a lender how good you are at managing debt and how much of a flight risk you are. It's a number that tells them if they should lend you money, and if they do, how long the term should be and how much they should charge you for the loan. So it's kind of a big deal. If you don't have a credit score, or if you have a bad one, it'll be really difficult to borrow money for the larger things in life. So what is the score anyway? How did they come up with that 3-digit number? Well, that's where things get a little bit hazy. Most people don't know this, but there's not just one method of calculating credit scores. Actually, there's a lot of different models that are used depending on the type of credit reporting agency you're dealing with, depending on the lender, and depending on the type of loan that you're applying for. Some of those include the FICO credit score, the VantageScore, TransRisk, Experian's National Equivalency Score, and many others. But most popular among all categories, and the model that most people are familiar with, is the FICO score. FICO is short for the Fair Isaac Corporation, and the FICO score is their model of calculating your ability to manage debt. Like most of the credit scores out there, the FICO score results in a number somewhere between 300 and 850, and the FICO score is used by over 90% of the top lenders when making lending decisions. Generally speaking, if your score is less than 580, it's considered poor. Between 580 and 669, it's fair. Between 670 and 739, it's good. Between 740 and 799, it's very good, and anything above 800 is considered exceptional. The average score in the US is about 695, which means that most people have good credit, but not great credit. So I think that covers pretty well the question, what is a credit score? Let's move on to why it's important. Let's start off by answering the question, how can a good credit score make your life easier? Well, I've touched on this a little bit already, but the main point here is that if your credit score sucks, you won't be able to easily get loans from lenders because most lenders will look at your score, and depending on where it falls, they'll make a judgment call on whether or not to approve you for a loan. Generally speaking, if you have an exceptional credit score, again, that's a score of more than 800, you'll have no problem getting approved for nearly any loan you could apply for, assuming that you tick the boxes on some of the other normal requirements for approval, like having a good debt-to-income ratio. By having an exceptional credit score, your possibilities open up to some really great options in terms of shopping around for lenders and actually being able to get loans for the bigger things in life. The lower your score though, the harder it's going to be to get approved. With a very good or good score, you're probably still fine in most cases, but you will start running into issues in terms of how much you can get approved. With fair and poor scores though, you're running into the risk of not getting approved for much of anything because your score says to the lender that you're a very risky person to lend money to. That score tells them that you either don't have much of a credit history, which means that your behavior is hard to predict, or that your credit history is riddled with mistakes that you've made like late payments or defaulting on payments. When it comes to making your life easier, there's also the issue of what happens when you don't have a credit score at all. Let's say that you want to go out and buy a home for you and your family. If you don't have a credit score, it's completely possible to do this, but it'll be more difficult and it'll likely cost you more money. See, having a credit score makes it incredibly easy for lenders to determine your eligibility for the loans that you're applying for. They can request your score, plug it into their algorithms, along with some other information they'll get from you, and they'll have their answer. If you don't have a credit score though, the only way for them to determine your eligibility is to do what's called manual underwriting. It's a major hassle for you in terms of documentation, effort, time required to make it happen, and it's also a hassle for the lender, which is why most lenders won't even bother. If you don't have a credit score, most lenders are just going to deny you outright without even trying. You are the one who's going to have to shop around for a lender that'll work with you if you don't have a credit score. Also, if you don't have a credit score or if you have a bad one, you should expect to only be approved for loans at a higher interest rate than you would if you had excellent credit. This is why I'm a huge proponent of making sure that your credit score is as high as possible. It can literally save you thousands and thousands of dollars over your lifetime with almost no effort at all. But let's take a look at a quick example. So what I've got on the screen here is an example of two people. One person has an excellent credit score and one person has a poor credit score. They're both going after the same house. They're both wanting to borrow $250,000 over 30 years, and they're both going to get approved in our example. In all likelihood, though, the person with a poor credit rating is most likely not going to be able to get approved for a $250,000 house, but we'll come to that later. With this example, let's assume, though, that they both get approved and the person with an excellent credit score is going to be given a 3% interest rate on their mortgage. That's pretty standard these days for excellent credit. But the person with poor credit is going to be given a different rate. Pay attention to the two numbers. Our payment amount per month for the person with excellent credit is $1,000, a little over $1,000, and the total interest over the 30 years is $130,000. Now, if we bump our interest rate for the person with poor credit to 4.5%, we can see the difference. They're going to be paying about $1,266 per month, not $1,054 per month, and over the course of 30 years, their interest is going to be $206,000. That's a $76,000 difference between an excellent credit score and a poor credit score. Nothing else is different about these situations. So it's clear that you need a credit score and that you need a good one. How do we make that happen? What factors actually make up your credit score? Well, it depends on which type of credit score you're talking about, but FICO, again, is the most popular, so let's take a look at that one. FICO is made up of 5 variables. 35% of the score comes from your payment history, 30% comes from the amount of debt you carry compared to how much credit you have available, 15% comes from the length of your credit history, 10% comes from how many hard inquiries you've had over the past 12 months, the average age of your accounts, and the age of your youngest new account. And finally, 10% comes from your credit mix, because they like to see that you can handle multiple types of debt, like credit cards, retail accounts, installment loans, and others. As another example, the VantageScore is similar, but it has its own specific details. 40% of the score is from your payment history, 21% from the age and type of credit you have, 20% from the credit utilization, 11% from your total balances, 5% from your recent behaviors like new accounts and hard inquiries, and 3% from your total available credit. So you can see there's some differences in the models, but the same basic principles apply, and this answers our final question. How can you get a good credit score? Well, all you need to do is look at the factors that the models think are important, and it all boils down to some pretty basic guidelines. First, always make sure to pay your bills on time. Having a negative payment history is a huge red flag to lenders that you are a risky borrower. They want to make sure that when they lend you money that you're going to pay them back on time, consistently, every month. If you do miss a payment on one of your bills though, correct the issue as soon as possible, because how late you are also affects your score. And honestly, in most cases, if you're only late by a day or so, most lenders won't even bother reporting it, especially if you call them very nicely and ask them not to. A phone call can go a long way sometimes. Second, keep your credit utilization as low as possible. This is just a ratio of how much debt you are carrying compared to how much credit you have available. There's 2 ways to do that, of course. Number 1, don't use your credit lines too much, and number 2, increase them when you can. But to clarify, it looks good for lenders if you have a little bit of debt that you're paying on every month. It shows them that you can consistently pay, and it's a green flag for them. My recommendation here is just to use your credit card for everything and pay it off every month, or in other words, live below your means and stick to your budget. There's no reason you shouldn't be able to pay off your credit card every month if you do those things, and this will help increase your credit score over time. Plus, you can take advantage of all those sweet, sweet credit card points. Third, start getting credit lines as early as possible, and don't close old accounts. Increasing the length of your credit history is often just a long game. It takes time, but just be sure to not negate your hard work from earlier in life by closing your older accounts. If you're 18 years old, go get a small credit card, buy a small necessity on it every month for less than $10, pay it off every month when the bill comes. Do that for 5 years and you'll be set. Fourth, don't open too many accounts too quickly. I'd recommend 6 months between opening a new account on average so that you don't hurt your new credit ranking of your FICO score. And finally, fifth, there's the credit mix. This one will naturally happen over time, so I generally don't worry about it too much. If you're starting from nothing, it'll take you a few years to get above 800, but getting above 700 really takes no time at all, usually less than 6 months for most people. And once you're in the range of having a good credit score, you're already making your life easier, and you're preparing for future you to save money at the same time. There's a lot of good reasons out there to have a good credit score, but like most things in personal finance, it can all be helped along by having a good foundational basis of money management, which starts with having a good budget. So do this, click on the playlist on the screen right now, because in those videos, I show you in depth how to create a budget using spreadsheets from start to finish. Thanks for watching, and we'll see you next time.